can we expect with from the Fed? Largely, they're going to go steady and hold on to the rates. The market is pricing in, however, a cut of 50 basis points all through this calendar year. A view on macro, what the Fed is keenly putting on their radar. And yeah, the fact that they could actually hike the inflation outlook and cut the GDP estimate, that is something that the street is going to be very keenly looking out for. But let's pick up the conversation forward. We've got Ed Yardeni as well joining in on the show right now. Ed, hi, good morning to you. What's your expectation from the Fed this time? A status quo?
Nothing, yes, status quo, nothing different from everybody else. I think the Fed has communicated that they are in no hurry to ease. I view that as a fundamentally dovish stance because the alternative would have been to say they're in no hurry to do anything, in which case the message would be rates could be here for a long time, not going up, not going down. But they have been saying over and over again that they are in no hurry to ease. So they're clearly thinking about lowering interest rates. And depending on how this tariff turmoil turns out, there may be a weak enough economy out there that they will ease. The problem is they may also get some inflation out of tariffs. So they could really be boxed in and really be in no hurry to do anything for a while.
Okay. Do you think, considering that the tariff impact will now be evident, let's say, in coming quarters, any view on inflation, which in a sense is the benchmark for the Fed to decide interest rates, would be naive? Because you don't know whether it's electricity or aluminum cans. You don't know whether it is cars or scooters. Something will go up and something will come down.
Yeah, and that's true. And I think that we have kind of a mixed picture here. Tariffs are basically a tax on consumers. I mean, somebody's got to pay it, and usually it's the consumer that pays it. And so, but it could be in just kind of a one-shot hit for a month or two, and then things could stabilize. But tariffs can also depress the global economy, which would be fundamentally deflationary. So I'm thinking that the inflation outlook is going to be the least of our problems. The big issue will be the impact of potential tariff war on economies around the world.
Of late, Ed, it clearly seems to be evident that money has started moving out of US. Will it find its way back into emerging markets, or it could go back to Europe?
Well, I think that's a good question. I think we can observe that as the U.S. stock market has weakened since middle of February, as the Magnificent Seven have declined by about 15% since the beginning of the year, other stock markets have actually done well. Germany, China, India seems to be stabilizing. So I think money already has been going global. That's left the United States, and that may continue to be the case. It's as though the stock markets are saying that the tariff situation is going to be worse for the U.S. than it's going to be for the rest of the world. But I think the markets are also saying that the U.S. has been expensive, valuation multiples have been high, and people are looking for lower PEs, and they're finding it outside the United States. I think the other consequence of Trump 2.0 is that Trump has actually managed to get the Chinese to try to stimulate their consumers. That's something that American politicians have been trying to get the Chinese to do for a long time, and that seems to be what they're doing now. I don't think it's going to work, but they're going to try, which is nice for a change. And at the same time, Trump has managed to get the Europeans to do more deficit financing. The problem is that's keeping bond yields up all around the world.
Interesting. Okay, Ed, Fed is on our mind. We'll chat again once the Fed outcome is out later tonight. Good having you on the show.
Thank you.
If you like this video, then like, share and subscribe to ET Now.